What's up, everybody? This is Sunko, the Korean Bro. Today is 2023, February 2nd. Okay, let's start reading articles, okay? Billionaire investors are trying to turn around these two stocks. Should you buy? Three ultra profitable business to invest in for the long hour. 8 million reasons to like Netflix stock. Two dividend stocks that could increase their payouts in February. Three dividend stocks near their 52-week lows to buy right now. A bull market is coming, one growth stock down 60% to buy and hold forever. For short squeeze, history suggests Nasdaq could soar in 2023. One stock split stock Wall Street says to buy hand over fist. Carvana stock 187%. Will its streak continue? One stock split stock that's a surefire February buy and one to avoid like the plague. Okay, well, we got a lot of articles to read tonight. Let's see, one by one. After plunging last year, shares of Alphabet and Salesforce looked cheap by some metrics. Both companies face challenge beyond just cost cutting. The two stocks could have a lot of upside potential amid an economic recovery. We got Salesforce. Okay, last night we talked about Salesforce, right, and the service they provide. Salesforce, the service they provide is CRM. Abbreviation of CRM is Customer Relationship Management. Um, their main goal is to wow customer. As a company, they got a lot of data about customers, but then it's no use if the data is not being used well. So what they do is use the data and organize that data and make it into meaningful one, so that when customer needs specific product, they can provide that service to the customer right away. They kind of relationship management uh tool is provided by Salesforce, and Salesforce is like a leader in this industry. And it's no brainer buy. And let's see the reason why he says it. Okay, the price may not be right. Perhaps the biggest reason that both Alphabet and Salesforce are receiving interest from active investors is that these two stocks have fallen sharply from their peaks seen earlier in the pandemic. In 2022, both Alphabet and Salesforce lost nearly half of their value. Right? Hold on. Okay, hold on. Let's see. Snowflake, PayPal, Salesforce. Okay. It's not surprising that the sell-off in two being named tech stocks attract attention from activists, but there was a clear reason why both pulled back sharply last year. The growth rates have slowed substantially. In the case of Alphabet, the company posted a revenue increase of just 6% in quarter third, Analysts expect its growth to fall to low single digits over the two following quarters. Should you follow the billionaire investors? At their current prices, both Alphabet and Salesforce look appropriately priced. After all, Alphabet trades at a price-earnings ratio of 19, below that of the S&P 500, but these companies also face non-cyclical risk that could jeopardize their growth potential. The introduction of ChatGPT from OpenAI led to a code red at Alphabet headquarters, and now Microsoft is expected to incorporate ChatGPT in a new version of its Bing search engine as early as March. In China, Baidu has also announced plans for a new chatbot powered search. Hmm, blah blah blah. Okay. Next one, three ultra profitable business to invest long in for the long hour. AV is not only incredibly profitable, but its business is also broad and full of growth potential. AV, let's see, AV. Okay. Nvidia's profit margin has been dropping of late, but it's still in great shape to handle any adversity. Visa had an impressive quarter, reporting double-digit sales growth and strong profits yet again. Okay. AbbVie, drug maker AbbVie, has reported $13.3 billion in earnings over the trailing 12 months, which is nearly one quarter of its top line of $57.8 billion during the time. The business has been expanding over the years, helped by $63 billion purchase of Botox maker Allergan in 2019, which diversifies its operations and gives it a new growth opportunity. So they are a drug company. Okay, I get it. Next, 8 million reasons to like Netflix stock. Netflix added 7.66 million customers in quarter fourth, beating management's own forecasts. Huh? Netflix registered gains in each of its regions, with mature markets like the US and Canada still finding ways to grow. Gains in each of its regions, with mature markets like the US and Canada still finding ways to grow. There is still a huge global opportunity for Netflix to continue tackling. The streaming pioneer is getting back to its old ways. 2022 was a wake up call for Netflix shareholders as the entertainment innovator got off to a rocky start, 1.2 million customers in the first 6 months of the year. Hmm. Because this is easily the most closely watched metric for the business. It's no surprise its stock was down 67% between the start of 2022 and the day the company reported second quarter earnings on July 19. Hmm. Posting a better than expected quarter. Okay. The three dividend stocks near their 52-week lows to buy right now. Medtronic, they're all profitable businesses that can provide your portfolio with above average payouts. Public Storage and Kroger. Medtronic, medical device maker. Public storage. The real estate investment trust has a portfolio full of self-storage options. REIT, Kroger. Okay. Next, Snowflake. Okay. Another one, Snowflake. Let's see. The business is growing quickly and is likely just scratching the surface of its long-term potential. Has strong service offerings led by impressive management team. Okay. This category leading tech companies building the foundations for incredible long-term performance. Growth stocks have been pummeled this past year by an onslaught of unfavorable macroeconomic conditions, including inflation and rising interest rates. But the tough time won't last forever. While it's impossible to say exactly when the next bull market will kick off, history has shown again and again that the market always bounces back, even from the most challenging periods. Hmm. Crucial services in a top tier management team, impressive momentum and long runway for expansion. Uh, okay. Staying as the market largest suppliers of cloud infrastructure services between websites and application, the vast majority of large businesses rely on services from more than one of these providers. While multi-cloud setups have become the norm, it's actually not easy to combine and analyze data generated across these distinct cloud infrastructure services. Hmm. Snowflake's data cloud platform solves this problem. All of its customers get a far more comprehensive data analytics picture. This is already a mission critical service for many businesses, and it will only become more essential as digital transformation trends continue to reshape global commerce. On the management front, investors can be confident Snowflake is in very capable hands. Its president of the product division, Benoit Digaville, was co-founder of the company in 2012. Since the company's formation a little over a decade ago, Digaville helped shape the overall data warehousing category and made Snowflake a category leader in this increasingly important niche. Meanwhile, CEO Frank Slootman stepped into the chief leadership role at the company in 2019 after previously serving as chief executive at ServiceNow for roughly 6 years, during which revenue climbed from $100 million to $1.4 billion. This is the kind of team you want for driving an innovative, rapidly expanding business. So they got pretty much what they need. They got great workers who has achieved some success in the previous uh, companies that they had to work for. So impressive momentum and long runway for expansion. Mm, okay, Snowflake. Okay. While the economy started to feel macroeconomic headwinds the past year, it should continue to post relatively strong sales growth in 2023. Snowflake ended the fiscal 2023 third quarter with remaining performance obligations of $3 billion, up 66% year over year. And it's providing services that have become essential for many large customers. Hmm. Midpoint guidance called for product revenue to grow roughly 49.5% in fiscal 2023's fourth quarter. And management expects 47% annual growth in product revenue in the current fiscal year. Strong sales growth is a testament to the fact that Snowflake is providing high quality, strong sales growth, right? It's a testament to the fact that Snowflake is providing high quality, in demand services, but the company is in the early stages of carrying out a much larger, more ambitious part of its long term growth strategy. With disruptive victories in the data analytics and collaboration spaces already achieved, the software companies are now aiming to disrupt app development itself because it enables clients to easily combine and act on data from disparate sources. Okay, what I get is that they make um, organization of data simple. So it's pretty much about how they deal with data, right? Uh, they combine and act on the data from disparate sources. We got a lot of sources. It's not organized, but they make it organized. That's what it is. Snowflake's platform offers some powerful advantages when it comes to developing and running applications, building and running software natively on Snowflake's platform can allow more efficient and comprehensive integration of valuable data. As here, the long-term promise of the company's usage-based billing model really begins to shine as a growing number of applications are built and scaled on its platform. Snowflake will see customers use more services in conjunction with scaling engagement for their applications. Snowflake expects to reach roughly $10 billion in revenue for its 2029 annual fiscal period, which ends in January of that year, and post an adjusted free cash flow margin of roughly 25%, putting the highly growth dependent nature of the company's current valuation in perspective. The stock is trading at roughly 20 times its free cash flow target for the 2029 fiscal year. Okay, let's see a video clip about Snowflake. Okay, what is Snowflake? How did they become such a renowned business? Hmm. Data warehouses are rigid, expensive, difficult to use, need to be speedy, easy, cost efficient. Hmm. Okay. Okay, I get it. So Snowflake, Snowflake. If you're using the service provided by Snowflake, um, you can organize your data and like you can share important logic or some things with other companies listed in the Snowflake. Um, so it's pretty much like a platform where a lot of companies share um, mm, some kind of important data so that uh, as a customer of Snowflake could have deep insights about customer and like and things that lies ahead, you know. I don't get the part where it says about sharing logic in business because business can exist once it has an important business logic or something like that. Otherwise, it would have no advantage, right? Business is all that is to make the company gain some money, but if it's shared, then there's no confidential thingy, right? So that's the part where I don't understand. Uh, but anyhow, uh, if you're using data cloud provided by Snowflake, it's a lot of companies using Snowflake can also hmm, share some important tips about business. Hmm. Okay, I think that's what it is about the Snowflake. That's enough of it. It's not like I understand it 100%, but then let's skip and go back get back to here next time. Okay. The history suggests Nasdaq could soar in 2023. One stock split stock Wall Street says about handle first. The Nasdaq 100 index has only fallen in consecutive years one time in history, dating back to 1985, which bodes well for 2023. The index has soared by an average of 51% in the first positive year following a loss. And it's already up 10% in 2023 for a whole host of reasons. Palo Alto Networks. Okay. Cybersecurity juggernaut has made all the right move in preparation for a new wave of growth. Alto stock split it positions it for a next wave of growth. Hmm. Wall Street is overwhelmingly bullish on the stock. Okay. Let's read this one. The company is recognized as leader in 13 different segments of the cybersecurity industry across its three core business units: network security, cloud security, and security operations. Many of those accolades are cloud centric, which is a core focus area for all organizations as they adapt to an increasingly digital environment. As large companies in particular shift their operations online, the attack surface is growing rapidly, which makes them more vulnerable than ever to malicious actors. Palo Alto is one of the most experienced providers when it comes to complex security needs, given the breadth of its product portfolio. That's why it has a 1,262 customers spending at least $1 million per year. But simply, some of the largest companies in the world have turned to Palo Alto to protect their digital assets. There's further evidence in Palo Alto's growth rate. It generated $928.1 million in revenue in fiscal 2015. Now, 8 years later, the company is on track to deliver $6.9 billion during fiscal 2023. That's an on outright increase of 643%, or a compound annual rate of 28.5%. Okay, not a single analyst among the group recommends selling. Okay, let's look at a video clip about Palo Alto Networks. Okay, Palo Alto Networks. Okay, so I get it. The I just look at the video clip about Palo Alto Networks, and the CEO of this company um talked about why he started this business. And every he says that wherever he went, most of CEOs talks about uh, their plan to have their business uh, uploaded on cloud, and like, I'm gonna have that you know I'm gonna have that, have it on cloud, have it on cloud. But then we don't have any single cyber security for cloud specific. So he thought that it's definitely algorithm that we need uh, for secure use of cloud service, cloud specifically. Uh, he says that's why he came up with this kind of cybersecurity system. Mission driven innovation. Mm, mm. As the time goes by, business will have more IoT devices. And if you just look at your office, you will notice that there are a lot of devices, electric devices, and like computers everywhere, data is everywhere. And it's no doubt that security is really important, especially in this environment, right? They're not designed with security in mind exactly. They're not designed with security in mind exactly. Mm. Quality of service, safety, brand. Yes, yes, that's a major concern. Can you really trust the devices on your network? Once it's impacted, customers will not rely on your system, right? Okay. Let's briefly sum up. So Palo Alto Networks, they started up their business mainly because CEO thought that there's no single service for there's no single cyber what is it, cybersecurity service for cloud specifically. So he started it. And like the video that I'm watching is about IoT security by Palo Alto Networks. Their main goal is to let customers use their system easily. It should be easily deployable, and like they eliminate sensors and they make it easy to have an integration, and they eliminate additional overheads, and like they got like powerful firewall which can block potential threats from attackers, right? Mm. Non-intrusive cloud, non-intrusive cloudless, cloud-based empowers your security team. Okay, that's all about it. So Palo Alto, there's a ton of reasons why I should invest in this one. Mm. And customers, um, mm, gotta have trust for this company, right? Mm. Okay, let's go to next one, next article. We don't have that much time. For high yield dividend stocks, billionaires can't stop buying. AT&T, Paramount Global, mm, Ford Motor Company, Enterprise Product Partners, Walgreens Boots Alliance, Walt Disney. Okay, this is one is really interesting. Carvana is popular among short sellers, but a short squeeze is driving up the price of shares. Don't fall for the trap. Carvana's financials are still treacherous. Okay. The short squeeze casino has opened once again. It's been a while since short squeezes were in the news, but they're seemingly back. The market has built solid momentum in recent weeks, and travel online car dealers Carvana has seen its stock nearly triple year to date, with the bulk of its gains coming in the past week. The stock is still down a whopping 96% from its all-time high, so there is room for it to continue running. But does that mean you should chase the potential returns? No. Feeling the squeeze. Investors can borrow shares to sell them. Approach is known as shorting. Short sellers' goal is to buy the shares later at a lower price, profiting from the difference. Buying shares to repay the broker is called covering a short. When many investors have shorted stock, rising price can result in those investors scrambling to cover their short positions, resulting in a surge of demand for that stock. This is known as a short squeeze. Much like frenzied buyers can keep pushing a hot stock higher, Carvana stock has been pushed to its deepest lows by short sellers. You can see below how the percentage of shares sold short has climbed over the past year. Be wary of weak fundamentals. Okay, they got weak fundamentals, right? More importantly, stock's underlying fundamentals will be the primary driver of its share price over time. Carvana is indeed struggling right now, which explains the heavy short selling activity. Hmm. Will the stock continue climbing? You want stocks to go up because the business has robust financials or strong prospects, not because of something unsustainable like a short squeeze. The stock could continue climbing higher, but you don't know when the music will stop. Chasing quick gains from a short squeeze isn't investing, it's gambling. You can participate as long as you understand the substantial risk involved and only use money you can afford to lose. You should look elsewhere if you're trying to identify long term investment that can build wealth for you over time. So it's risky, right? Right when the trade that started thriving business with double-digit revenue growth, their stock charts have been plunging lately. This massive growth story should develop over the next decade and beyond. Buying these neutral power growth stocks today, fatter sale price can set you up to make a lot of money. Okay, once again, let's look at the trade desk. Hmm. By former Microsoft employees. Okay, he was Microsoft employees. Okay, I get it. He still serves today as a company CEO and a chief technical officer. That's another promising long-term connection between the founder's original vision and the state of real-world operations. Many years later, great stuff. This company combines a deep expertise in running automated marketing plans with a massive client list and a commitment to the open internet, accessible to everyone. That pledge includes the game changing introduction of Unified 2.0. This anonymous data collection tool should become the de facto ad industry standard. When the major web browsers stop supporting third party tracking cookies, an unstoppable change that's already halfway complete. In other words, the trade desk is uniquely equipped to handle the next era of online advertising campaigns. So they're like setting new rule, you know, that important, okay? Is the literal inventor of the next generation technology through which ad managers will keep an eye on the performance of their campaigns. The literal inventor of the next generation technology through which ad managers will keep an eye on the performance of their campaigns. Even without that advantage, the trade desk could conceivably make do without advanced tracking. Um, Tech, since it has access to publishing data via long-standing relationship with every major player. The trade desk exists to make online ads more effective and less intrusive. When the company does a good job, it generates more ad-based sales while keeping more money in its client pocket. We're looking at another long-term winner here as advertising dollars keep moving after all billboards or TV screens and onto online content platforms. If that sounds like a good idea, you should put the trade desk near the top of your list for further research and start buying ideas. Enough of a trade desk. We covered part of it today. Anyway, this is it for today. It's been only 50 minutes already passed. So I'll see you guys tomorrow or the day after tomorrow. Okay. Bye bye and have a good night.